Good afternoon, everyone. Robert Rayburn here from Life Pro Asset Management. It is May 8th of 2023. I hope that everyone had a great weekend. We have a lot to go over this week. The regional banking crisis continues to stalk the economy and the markets, and it's been leading to a lot of volatility. Last week was an interesting week, one where I think an overall asset allocation plan has been making some steps there in the right direction. We're happy to see that. But we have to be vigilant. We have to make sure that as this crisis unfolds, that the portfolios are staying fresh as it relates to how this crisis is unfolding and the potential resolution to it and what it means for economic growth rates, what it means for interest rates, and just as important, what it means for the US dollar. So we're going to go over all of that this week. The title of this week's presentation is the Fed asleep at the wheel? So we're going to go through three big things. The risk we think is at the top of the market. And we're going to go over what that really means. Number two is the regional banking crisis overtaking inflation as the primary threat as observed by the Federal Reserve. And number three, what are the benefits from a lower rate environment? In other words, what are the asset classes in this type of macro environment where rates move lower that would most likely benefit? So we'll go through that, all of those main points this week, but we wanted to start off with focusing on the possible bubble at the top of the market. One big theme that we have been focusing on since the start of the year is the fact, or really actually since mid-February, is the narrowing of market breadth. So in other words, as the stock market has moved higher, fewer and fewer stocks have been participating in the rally. Now, this has been a reflection of money moving out of small caps, out of mid caps, even out of many large caps and into the mega caps, right? So like the Apples, the Microsofts, the Googles, the Nvidias, the Teslas, the Mercks, the Home Depots of the world. These are the types of stocks that everyone is piling into. And you can see that both in the breadth data, as that breadth has narrowed, despite the fact that the market is sitting near recent highs, but then also looking at the short interest as a percentage of the overall float of these stocks. So short interest in Apple, 0.8%, in Microsoft, 0.5%, 0.6% for Google. In other words, there's almost no interest whatsoever in shorting these stocks. Why? Because everyone's piling into them. And similar to that movie theater, the more and more people you get piling into the top of the market, the riskier the top of the market becomes, and the riskier that someone just yells fire, and that causes a tremendous sell-off at the very top of the market where everyone is exposed to. We actually don't have much exposure to many of these names, especially in technology. Our tech weight remains 0%. But that is something we want to continue to keep an eye on because it does impact the indexes, right? Because technology and communications are the biggest part of the market in the US. If the top of the market starts to crack, you could see some weakness there in the market. Now, on Friday, we had a great employment report. I think we beat by over 100,000 jobs. And then you had a market that rallied. So people are sort of saying, hey, good jobs report, good market. Not so fast. A few things. The market was a little bit oversold going into Friday's report. Friday's report did confirm that, hey, we're not going into this recessionary spiral that maybe some people were worried about a couple days before. So the labor market still looks relatively healthy. But here's the issue. More jobs equals higher wages equals higher rates, right? So that's sort of been the typical thinking. But here's the fly in the ointment. Higher rates, generally speaking, can also mean more bank stress. So if we look at the current regional banking crisis that's taking place right now, and it has actually been caused by the higher rates, the marking down of those government securities on the balance sheet, plus the withdrawals taking place. So they can't fund those withdrawals because their securities are being marked down by higher rates. All of this is leading to a lot of stress. So if you get more jobs and higher wages and higher rates, in a way, it creates more bank stress. And if you get more bank stress, then there's a rush for safety. And guess what happens? Rates actually go down. And what happens in markets is investors skip the middle step and go straight for this bottom line, which is higher rates could lead to bank stress, and more bank stress could lead to rush for safety and lower rates. So for us, what benefits from lower rates? Well, we get a weak US dollar and a weak US dollar should be good for gold. So you see how that works, where yes, you could very well get higher rates as a result of the better jobs, but that has been the very problem for the regional banks, and that is causing the crisis and that rush for safety, which is good for gold historically. On top of that, we continue to see these very stressed out credit default swap levels for US sovereign debt. What on earth is happening here? We put that quote there, and I stick with it, because even on a good day in the market, you've got barely any improvement on these US credit default swaps for sovereign US debt. June is increasingly looking like the midnight date for this entire US debt ceiling debacle. So we continue to believe that this is a debacle. We also are concerned as what does a debt ceiling deal look like? In order to get Republican support to pass the debt ceiling and to raise it, there will likely need to be some sort of spending cut measures that go into effect. Spending cuts equal lower GDP. Lower GDP equals lower US dollar. That's also should be good for gold. We can see here in this chart, the regional banks continue to sell off. We had a pretty sharp rally on Friday. That looks like short covering to us. I wouldn't be buying the regional banks here hand over fist. I'd be really careful, not just with the regional banks, with the banks as a whole. Our bank weight remains 0 across the board. We own one bank in the blue chip strategy, Morgan Stanley, but that's about it. In the opportunity and the other strategies, we have 0% weights across the board. So, our big concern here as it relates to the banks is there doesn't appear to be any resolution in sight. You get these banks individually that default or go to 0 or have to be rescued. And the issue here is this thing is increasingly feeling like it's spreading. And if it does spread, DC is going to have to act. But the problem right now is bank bailouts are not a politically easy thing to swallow. And if they can't pass the debt ceiling without a rancorous debate, what's going to happen when you actually have to get Congress to do potentially bank bailouts? So this is why we're concerned. I think the charts speak to that concern quite a bit. And then we also see here, when we look at the two-year interest rate in the bond market, and we look at where the Federal Reserve policy is right now, this is the bond market's telling the Fed, you are way too tight right now as it relates to Federal Reserve policy. You need to start to lower rates. So when is the last time that the two-year yield was this far below the federal funds rate? That was in 2008. Now, this is not 2008 in our belief at all. It's a different type of crisis. But what this does signify is how disjointed the Federal Reserve policy is from the market reality on the ground. And usually 9 times out of 10, the bond market's right and the Federal Reserve adjusts to the bond market environment. And we don't think that today is any different. We do expect us to be very, very close to the end of rate hikes, and we could very well be talking about rate cuts going forward. Most certainly, we think the Fed is on pause at a bare minimum. So what are the key questions? Are rate cuts the only way to solve this regional banking crisis? Because if we need DC involved as it relates to Congress, that's not good. Number 2, will DC swallow that political poison pill and bail out the banks? Again, I'm not smart enough or connected enough to know the answer to that. And does all of this lead to a weaker US dollar? And we know the dollar is important. The dollar is very important as it relates to asset allocation between US markets and international markets, EM and US, and EM versus Europe, and of course, commodities. And the one commodity in particular, gold. We look at the gold chart right now, trying to break out of this, call it close to a 5-year cup and handle formation as it relates to the charts. We look at gold relative to copper, that's sort of your safety versus economic sensitivity. Again, copper breaking down relative to gold, and the 10-year yield usually follows that path. So if the 10-year yield falls down, in line with that copper gold ratio, that could be very good for gold as well. So bottom line, ladies and gentlemen, despite that strong jobs report, the spreading bank crisis may require lower rates here at some point in the future. We're not the only ones saying that, so that sometimes gives us pause, but we're just trying to follow the facts on the ground right now. The top of the market does look like it is getting crowded. We would be very concerned about those mega caps. We're certainly not owning them here. Lower rates may be required to ease that banking crisis. And lastly, we do believe that gold and other commodities may benefit from that Fed pivot and lower implied economic growth. So if you want to know our thesis about gold and why we're overweight gold, please tune into last week's update or the week before. We go into in depth about why we own gold here and why we like it. I definitely encourage people to give those videos a watch. So have a great day, have a great week, and we'll speak again next week. Talk to you soon.